Hello everyone and welcome to another edition of the Money Pros. I'm Oliver Tutt. I'm a practicing financial planner, but for the next half hour I'm going to be your host as we talk about the issues related to your money. How to make it, how to keep it, and how to help it grow. Anything having to do with personal finance is fair game on the Money Pros. Certainly today's show is no exception. We've got a lot of things to talk about. First on the list, we're going to be talking about two rather large federal government organizations, the IRS and the Social Security Administration, both of whom have important information for consumers. So we're going to give you that information and keep you up to date on what's going on there. We have a special guest in the studio with me today. His name is David Byrne, and he's a risk management advisor with Starkweather and Shepley Insurance. And we're going to be talking about homeowners insurance, which is not a topic we've talked about here on the Money Pros. So I'm excited to get to him. Later on in the show, we're going to unravel some of the mysteries having to do with mutual fund sales charges. If you've ever looked into mutual funds, you're familiar with various share classes. We're going to talk about what those share classes mean and how to understand what impact they have on you. And then finally, we're going to show you an interesting tool that I just became aware of to help you delve a little deeper into the 1040, the IRS 1040 tax return, long form, as well as Schedule A. Now, if you're a tax geek like me, you're going to be interested in digging into this form. Maybe some of you not so much, but it's an interesting interactive website we're going to show you. So we've got all that to get to on the show and a lot more, so let's jump right in. First up, we want to talk about some interesting consumer news coming from a couple of government agencies, and first up is the IRS. The IRS has released announcements to the public and to tax practitioners, making them aware of the fact that there are a variety of scams currently taking place having to do with calling consumers on the phone and impersonating the IRS and making consumers believe that either they are in line to receive an extra large refund or that they potentially owe more taxes, with the idea being that they're going to try to get that money extracted over the phone. The IRS wants you to know about this scam, and we've got some tips from the IRS to help protect you from that scam. So first up, the IRS always sends written notice of taxes due. So if you get somebody calling you on the phone and you've never received any kind of written notice from the IRS, it's almost certainly a scam. Second, the IRS will never ask for your credit card, your debit card, prepaid card, any kind of payment information over the phone. So they're not going to ask for bank account information or any credit or debit card information like that. So if somebody purporting to be from the IRS is trying to extract payment from you over the phone, again, very likely a scam. Secondly, the IRS does not initiate contact via email. It's a very common part of this scam for it to be prefaced with an email before the phone call. These scammers are very good at impersonating the IRS, the look of their website, the look of the logo, and everything like that. But the IRS does not initiate contact with taxpayers via email. So again, that's a sign of a scam. If one of these things happen to you and you suspect that there's a scam taking place, you can do a couple of things. One, you can call the IRS at 800-366-4484. This is not their general helpline, so you shouldn't expect to be on hold as long as you might normally be. Or you can go to the website for the Federal Trade Commission, who's responsible for investigating and prosecuting some of these crimes, and that website is www.ftc.gov. So important information for the IRS. We don't want you to get taken advantage of. We certainly don't want you paying out any more money in relationship to taxes than you absolutely have to, and that big refund's probably not there. Second, we're going to do this one fairly quickly. Social Security Administration recently has been telling reporters, we haven't seen any big announcements about this from Social Security, but they've let a lot of reporters know that they're going back to paper statements. And I'll tell you that that's something that I actually like. I thought the paper statement from the Social Security Administration letting you know what your benefit was, what your earnings history was a great tool to help you with your financial planning. So here's what you need to know. Paper statements were discontinued in 2011, and they were actually discontinued in an effort to save money related to the financial crisis. I guess they're not quite as concerned about saving money anymore. The statements will not go out around every single birthday. They will only go out around birthdays ending in 0 or 5, starting age 25. So 25, 30, 35, etc. And then when you hit 65, they'll go out every year. And finally, you can still get electronic statements. Again, another very useful tool, logging in, setting up an account at ssa.gov/mystatement. So you can look forward to, according to the IRS, receiving your paper statements once again. So a couple of interesting pieces of information. I hope you find them useful. Up next, we're going to have David Byrne. He's a risk management advisor, Starkweather and Shepley Insurance. We're going to tell you everything you need to know about homeowners insurance coming up next right here on The Money Pros. Stay with us. Hello, everyone. Welcome back to The Money Pros. I'm joined now by a special guest. He's David Byrne. He's a risk management advisor with Starkweather and Shepley Insurance here in Rhode Island. And we're going to talk about a topic that I think it's really a crucial part of personal finance, and it's actually something we've never really covered here on The Money Pros, and that's homeowners insurance. It's one of your areas of expertise, so we're delighted to have you here on the show.
Thank you for having me. I appreciate it.
Thanks for being here. All right, so let's just talk a little bit about, some of the basics with respect to what homeowners insurance policies have in common. If anybody has a mortgage, they're going to have homeowners insurance, right? The lender's going to require that. To what extent are all homeowners insurance policies the same? In other words, do they have to follow some kind of formula at their most basic level? Is it a law, regulation, what have you?
Not so much a law or a regulation, but most insurance companies use a standard form, which is called an HO3 form. And it provides coverage for your dwelling, for other structures, for personal property, liability, and medical payments. What is also commonplace for most forms is the exclusions. Most homeowners forms, actually all of them, exclude flood insurance and earthquake insurance, which is very important. A lot of people think when they're buying a homeowner's policy, hey, I'm covered for everything.
Right.
And that's not the case.
All right, so let's talk about briefly, before we get to the stuff that's not covered,
Okay.
Again, some of the things that are normally covered. So you talked about, for example, liability, which is not necessarily, I think a lot of times when people think about their house burning down, my homeowner's insurance policy is going to cover that. I imagine as part of that standard form, fire damage would be typically covered as one of those things, right? Yep. But you talked about liability. That's not, an act of nature or something like that. That's a salesman coming to your front door and slipping on the stoop?
Yeah, trip and fall insurance is kind of what we call that.
Okay.
Which is why it's so important to always talk to an independent agent, in my opinion. Most policies will come with $100,000 of liability coverage just built in. And to get an increased, to get $500,000 of coverage will only cost about $50 a year with most carriers. So that's something that's very important that a lot of people don't know to ask for. Okay,
so what are some of the other things that were, would be, you rattled off a list there, typically covered with respect to a homeowner's insurance policy? So we talked about fire. What might be some other examples of things that most homeowners insurance policies should cover to some degree?
Theft,
okay.
Vandalism, malicious mischief, wind damage.
Okay. And they're going to have, take theft as an example, they're going to have different deductibles essentially. So if somebody comes and steals $50 off my bureau, my insurance policy might not necessarily cover that, or?
Yeah, that's an excellent point, yeah. And that's something that you can choose. The consumer can choose the deductible that they want. Some mortgage companies will say you have to carry a $1,000 deductible, but you can have a $500 deductible, a $1,000 deductible, $2,500 deductible. So if there's a claim where somebody breaks into your house and steals $50, that's not over your deductible, so you're not going to submit the claim.
And so that's a way potentially to manage the cost of the policy, right?
Exactly.
All right.
Now, I'm sorry. So what's important to know too is sometimes if you called your insurance company, if it's a 1-800 number, you call them to put in a claim, even though that claim is not covered, that can still be a strike against you. And it could still affect your insurance premium at renewal, even though there was nothing paid out on the loss.
So if I call up and I say, I had $500 in cash stolen, my deductible's actually $1,000, they say your policy, we have no responsibility to pay out on this because it's under the deductible. But you're saying that could still impact my claims history and then hence potentially my rates going forward?
Absolutely, yes.
So I guess it behooves the consumer to make sure that they're familiar with their policy and not be calling the insurance company just on the off chance they might cough up a check. Is that sort of the idea?
Exactly. And once again, bringing it back to the independent agent, and that's something.
I'm going to want to call my agent because that's not.
And we're going to counsel you not to put the claim in and then that's what we're going to do.
All right, we're going to talk more about that in a second, but let's talk about the next thing you mentioned, which is, we've been going through many of the things that typical homeowners insurance policy will cover, but there's a pretty important list of things that homeowners insurance policy will not cover. And one of the things you mentioned was flood. I found in my experience that a lot of the misunderstanding about homeowners insurance, even misunderstanding I've had, candidly, has to do with water damage and what how the water damage originated. So can you sort of help clarify what a normal homeowners insurance policy would and wouldn't cover as it relates to that sort of broad area of water?
So what's going to be excluded is called seepage. So if you're having water seep into your basement or seep into your dwelling through the ground floor, that's not going to be covered, okay? If there's a pipe that bursts in your basement and you get water that way, that's going to be covered. Most times, and I don't like saying that's going to be covered, that's not going to be covered, kind of in the broad sense. But the industry definition would be the seepage into the basement. That's going to be something the insurance companies are not going to cover.
So let me give you a couple of scenarios to make sure I understand. Let's say you live, relatively close to a river overflows and water floods into your basement or your first floor. That's sounding to me like something a typical homeowners insurance company
Perfect.
Is not going to cover, right?
Exactly correct.
You live at the beach, high tide due to a storm surge or something like that. Again, that kind of water comes in. Even if it comes in to the basement, it doesn't necessarily flood through the front door, but you get a flooded basement or something like that. What about something where the roof blows off your house in a storm and then rain comes in and most of the damage is related to the rain that poured into your house? How does that fall in the water damage universe?
Excellent question. Well, and that brings up an entirely different scenario, because kind of what you described would almost be a named storm or a hurricane. And unfortunately, we've seen a couple of those recently. So if the storm blows the roof off your house and water enters that way, that should be covered under your homeowner's policy. Where there's an issue is there's a lot of direct carriers nowadays that have hurricane deductibles.
Okay.
So if you live near the coast, if you live in Narragansett, and a lot of 1-800 companies will have a 5% hurricane deductible. So if that damage that you just described is from a hurricane and the house is insured for $500,000, your 5% hurricane deductible, if the damage is under $25,000, you're going to be self-insuring for that.
All right, so it's really an important factor as to whether it was a hurricane, at the time that it came on shore, do different insurance companies look at it differently?
Oliver, excellent question.
This is a critical issue here in
Yes.
Rhode Island along the East Coast.
That's an excellent question, and that's something that you're going to have, you look at your policy, because every company defines it differently. Okay? Some companies will say it has to be a named storm when it hits Block Island Sound. Okay? Some companies will say if it's a tropical storm, when it crosses the shore going into Rhode Island, then that's going to kick it in as well. So that's something that's company specific, and you really have to look at your policy.
So typical nor'easter, unnamed storm, roof blows off my house, rain comes in, that would typically be covered under the normal terms of my homeowner's insurance policy. But if all of a sudden that nor'easter is now Hurricane Sandy and blows the roof off, it's going to be covered, but it could be subject to quite a bit higher deductible than it would under other circumstances.
Correct.
Is that right?
Correct.
So let's talk about that seepage that you talked about.
Yep.
Most people would talk about or think of as flooding. My understanding is that homeowners that live within certain flood zones are going to be required to have specifically have flood insurance, which is separate from their homeowners insurance.
Correct.
I guess other people can have flood insurance too if they elect to have it. What is flood insurance, and what's going on with the flood insurance market, particularly here in Rhode Island, as a result of some of the storms we've had over the past couple of years?
Yeah, so that's something that's continuingly to develop. Kind of stay tuned on that one. The FEMA's looking into doing a remapping of the whole area.
So people that didn't need it before might now need it, and people that needed it might be even more expensive.
You got it.
Okay.
Yes. And in terms of trying to have the best insurance policy for these storms, at Starkweather and Shepley, we're in our 135th year in business, and we have companies that we represent where if you live right on the water in Narragansett, you're not going to have a hurricane deductible or a named storm deductible. We can also, what we like to do is evaluate your flood risk at that time.
Mm-hmm.
It's kind of the perfect time to look at both of them.
So it's a fairly complex equation, and there's a lot of things that need to be examined. Speaking of purchasing insurance, I think I know where you're going to come down on this, but I want to give you an opportunity to talk about it. There's no shortage of commercials out there about buying insurance online, whether it be Esurance or whatever else it might be. Spend 15 minutes, save 15% on your whatever kind of insurance. What's your thought on buying insurance online and what the importance of having a local agent might be?
Yeah, I mean, good. Excellent question. So within the last couple of weeks, there was a very well-known Rhode Islander, very wealthy individual. Will not mention his name. His file came across my desk. And we.
I wonder who it was. Go ahead.
So we evaluated his portfolio, took at the risks he has out there, and it looked at his auto policy, and it looked like he did buy his auto policy from a lizard, and he had state minimum coverage. Okay, so within about 7.5 minutes, okay, he could lose his entire fortune that he has built so many years to accumulate. So that's, once we looked at that and pointed that out to him, he had no idea. Mm-hmm. He had no idea if he was in an auto accident, the limits he had would not protect him over $50,000.
Okay.
So, I mean, that's, the type of services that we provide. So obviously, I think it's very important to speak with an independent agent.
So I think the idea would be it's a complex topic, and like any other complex topic, having a professional that's going to understand your needs and advise you on it is probably pretty valuable. Dave, we're going to have to hold you there. I got about 4 more questions for you that I'm not going to get a chance to ask, so maybe we can have you back sometime, but thank you very much. If you'd like more information on homeowners insurance or any other thing having to do with personal finance, you can let us know by emailing me, moneypros@foxprovidence.com. You can tweet at us. You can also find us on Facebook. So that's it for our interview. Coming up next, we're going to be talking about unraveling the mysteries related to mutual fund share classes. It's a complex topic, but I think we can help straighten it out. So we've got that, and we've got several other things coming up right here on the Money Pros, so please stay tuned. Welcome back to the Money Pros. Mutual funds can be a complicated topic, and one of the reasons that they're complicated is for something called share classes. One particular mutual fund, the ABC Growth Fund, what have you, can have more than one share class, meaning you have more than one choice of type of share of that fund. So even though the underlying investment objective may be identical and the underlying holdings may be identical, the mutual fund company has generated a multitude of different share classes, and the Cliff Notes version of those share classes is it boils down to how much you're going to pay to own that particular mutual fund. So it's important for investors to understand what share classes are and which ones are appropriate for their particular situation. I did a little research in advance of this particular segment, and I took a look at one of the largest mutual funds out there, and that's called the PIMCO Total Return Fund. And when I looked up PIMCO Total Return, I saw pretty much what I expected. That single fund with one investment objective, it happens to be a bond fund, actually has 9 different share classes. And those 9 different share classes represented differences in return of 1.25% per year from the best performing share class to the worst performing share class. Over a 10-year period, 1.25% per year adds up to a lot of money. The difference in expense ratio between the 9 was actually 1.6% for the most expensive and 0.46 for the least expensive. So I think that goes to show you that understanding the share class you're investing in is an important consideration as an investor. Let's throw up a slide, and I'm going to run through a few, but not all of the possible share classes you're going to run into. The first is A shares, and in many ways the A share can be the least expensive, particularly if you're able to buy the A shares in what's called an unloaded or load waived format. A shares represent a type of commission generally where if they're sold with a load, that upfront load, if you put in $10,000, $350 or so might go as a sales commission to the brokerage firm or whomever you bought it from. Next share class is B shares. B shares can be among the most expensive. B shares involve something called a contingent deferred sales charge. Not only will the annual expenses on a B share be among the highest of any of the share classes, but also you run the potential risk if you get out of the mutual fund in a short amount of time, anywhere from say 1 to 5 years, of incurring additional sales charges. And again, those sales charges go to the representative. And the next one is C shares. C shares can seem like the cheapest because there's no upfront load, but oftentimes C shares will have the highest annual expenses of any of the fund classes you have available. The last two, if I can have Eric throw those up all at once, we have I shares and R shares. I shares tend to be the least expensive share class. I stands for institutional, and those are for large dollar investors, but sometimes those institutional shares are available to consumers, particularly inside of 401k plans. And the final share class, R shares, you generally find those inside of retirement plans, sort of a middle of the road expense structure. So that's a very brief explanation of share classes when it comes to mutual funds, but it's important as an investor in mutual funds that you understand what share class you're getting, what the costs are, and what the impact is going to be for you. So if you've got questions about your investment, shoot me an email at moneypros@foxprovidence.com. Up next, we're going to take a look at an interesting tool for you to poke more closely into the 1040 and Schedule A. So stay tuned. We've got more to come right here on the Money Pros. Welcome back to the Money Pros. Last segment of the show, I wanted to talk about an interesting tool that I found. It's from the Tax Policy Center, and you can search for them on Google and go to their website and look for tax tools. And one of the things they have is an interactive 1040 and Schedule A. Now, why would you want to interact with a 1040 or a Schedule A outside of tax season? Well, if you're a tax geek like me, you can point to any one of the particular boxes on the 1040 or Schedule A, and you can get some interesting facts about how many people utilize various sections, where they come in, and they have some interesting statistics. So I went through it and I pulled out a few that I thought were interesting, but I'd encourage you, if you're interested in taxes and what goes on in the federal government, to take a look at it and see some of the facts that they have. The ones I pulled out, among the many, 120 million returns reported $6 trillion of income in the tax year that they examined. In this case, it was 2011. 6 trillion is a big number. 13 million people took $217 billion in taxable IRA distributions. 10 million people deducted $10 billion in student loan interest. 35 million people deducted $358 billion in mortgage interest. That's it for today's show. Thanks for joining us. We'll see you again next time on the Money Pros.